Let's do it, folks. Good morning.
Good morning.
I should say great morning because it is election day in America, folks. Welcome to the Streets opening bell here from Post 35 on the floor of the greatest financial institution in the world, dare I say. New York Stock Exchange. Tuesday, November 8th. Election day here in the United States of America. Did you get your stickers, folks? If not, at least here in New York City, polls open early today at 6 a.m. They will stay open until 9 p.m. throughout the five boroughs. Remember, it's important to vote. It's also very cool that they give you a sticker. That's my sticker. Opening bell rung moments ago by Kimberly Clark here in celebration of that company's 150th anniversary. Congratulations to them, and you'll hear them as they file off the trading floor here in the next few minutes. All of the major indexes finished Monday's session up for a second consecutive trading day. The S&P up 0.9, the Dow 1.3%, the Nasdaq up 0.8 as well. Futures were up a bit in pre-market hours today. This despite disappointing earnings after the close yesterday from names like Lyft and Take-Two Interactive. More on those names in just a bit. And since today is election day, in case you have not heard, all investors await the outcomes of the closely watched races all across the country, many of which, reminder, we will not know the result of for several days. I know a lot of people are eager for tonight. Election night returns. I promise you we're not going to have all the information tomorrow morning. The dust will not be fully settled. So it's more like election week in America, more so than election day. Elon Musk, for his part, for whatever it's worth, has weighed in with an endorsement of his own, taken to his new platform or his new toy, in the words of Barry Diller. Here's what he tweeted. Shared power curbs the worst successes of both parties. Therefore, says Elon Musk, I recommend voting for a GOP Congress, given that the presidency is Democratic. This despite the fact that earlier this year, you may remember, Elon Musk said Twitter needs to be apolitical in order to earn back the public's trust. Oops. But a divided Congress is not necessarily a bad thing for equity markets. After all, how many bills regarding new taxes or new regulations can you really pass if both parties don't see eye to eye on anything? And many people are wondering if the outcome of Republican control over one or both chambers of Congress is already baked into these markets. Is that the expectation? We will see. Let's take a closer look now. What is on tap for this morning's broadcast? We will talk midterms as Wall Street eagerly awaits the results of the election. Then we'll dive into earnings with big names like Disney and AMC, both reporting after the close today. And finally, we'll take a closer look at Tesla as the stock plunges to a 17-month low, trading at about 197 to kick off the session here today. For more on those stories and so much more, let's now bring in our senior editor and markets correspondent, Mr. Martin Baccardax. Happy Election Day. I do want to start there with Elon Musk's tweets from yesterday. Is that the prevailing sense, I wonder, Martin, among many CEOs, you think, that essentially vote Republican today, even if part of that reason is because you got a veto power in the White House and a broken Congress that doesn't work is probably a good thing for equity markets? What's your take on that tweet?
I think you could probably make that argument, JD. I mean, ultimately, I would say most company CEOs are libertarian in the sense that they would prefer to just be left alone to drive their businesses forward and to manage economic conditions as best they can. But then, of course, it has to be remembered that the moment things turn against them, they're lobbying government for support. I'm talking about things like the CHIPS Act. I'm talking about things like bailouts for failed Wall Street institutions, and you can go on and on down the line. So there's an old saying that there are no atheists in foxholes, and there are probably no libertarians at the helm of the biggest U.S. companies. But from a tactical point of view, I can see what Musk is saying. It probably is, from a business perspective, best to have gridlock government. It doesn't do anybody else any good because ultimately we're looking at 2 years of standoff and another bitterly partisan election in 2 years' time for the presidency. But I suspect that's what the outcome is going to be, and that could end up being modestly positive for stocks.
I wonder, aside from the financial argument you just broke down with regards to equities, which is a totally fair reading, are you surprised just personally see Elon Musk tweet what I can't help but describe as a pretty blatant endorsement the day before the election, especially considering the fact that, yeah, he's made some joke about trying to tick off both the far right and the far left, as he phrased it, but he has to know that in terms of advertisers, he's right with what he said before, right? This has to be a relatively apolitical platform, yet here he is essentially telling independent-minded voters how to vote.
If you could find an American institution that's apolitical, I'd love to see it because it would be an interesting observation. So I wouldn't imagine that Elon Musk is any different. And what's interesting, JD, is that for the most part, it's indicative of the fact that even if you're the richest man in the world, you simply aren't impervious to petty disputes and maybe some bitterness as a result. I mean, he has famously been critical of President Joe Biden for failing to include him on discussions about the future of electric vehicles, largely on the basis of his accusation that Biden doesn't like the fact that Musk is anti-union. There might be some truth to that, there might not. But irrespective of that discussion, it's pretty clear that Musk is no fan of the presidency, and that certainly is informing his opinion today. The apolitical nature of Twitter is simply impossible to calibrate because people are going to see it through their own prism. And I don't begrudge Musk the ability to express his partisan views in any case, because at the end of the day, the free speech discussions that we often have fail to grasp the central thesis, which is this. It's his company now. He paid $44 billion for it, and like it or not, he is allowed to say what he likes on his platform. And furthermore, he is entitled to limit the speech of others on his platform. Those are absolutely ironclad rules that have been established in law for many, many years. What they are going to do, however, is elicit responses from, as you mentioned, advertisers and users. And that's where the contradiction lies, because, of course, Musk has been intensely critical of people that he claims are chiding advertisers to pull money from the platform as a result of the political views, whilst he espouses his own political views at the same time. You cannot have one without the other, and I think ultimately it's going to take a long time for him to understand that.
Martin, you are a man of many incredible answers as we do this broadcast every trading morning. That was probably one of the greatest responses I've honestly heard you present in terms of an argument. This is a man who took over the platform. I mean it. I really mean it. I mean, that was really something. I really appreciate that context and perspective. This is a man who came in and said free speech absolutism will be a driving principle for his reign as ownership over the company. And I like that note about ironclad rules. Ultimately, that if you don't like it, then you as a user, then you don't have to be on Twitter. You don't have to be on the platform. So thank you for that. Very, very well said. And I also like the notes about libertarian CEOs as well. That's also very good. I do want to get, because this is something that you filed this morning over on TheStreet.com. You mentioned there a reference with regards to the election from a note from Saxo Bank. And I'm wondering if we could pull up this quote, Martin. I want to ask you about it after I read it. Saxo Bank saying that there are few immediate ramifications if the GOP takes both chambers, as Biden has a veto, of course, but a stronger than expected Democratic showing that somehow sees them retaining the House or strengthening the Senate majority would be a game changer, says Saxo, opening for more policy dynamism and inflation from fiscal stimulus from the U.S. in the next 2 years rather than the expected lame duck presidency. So here's a little bit of a warning shot, it sounds like to me, Martin, to say the expectation is sort of that Republicans will win the day here, but if Democrats for some reason exceed expectations, there might be a little bit of investing anxiety if somehow they can pull off that big upset. What stands out to you about that type of comment? Because I haven't frequently heard people say, hey, here's what you should know in case Democrats do better than we think.
Yeah. No, that's a very good point. It hasn't been part of the discussion, and it's a big reason why I like Saxo Bank commentary and refer to it most days, because they are able to look at these things in a more objective view, given the fact that they're located in Europe and not necessarily influenced by the biases of political opinion here in the United States. I think that tail risk of a surprise result for the Democrats, which is not out of the question given the vagaries of the polls that we've seen over the past few months, is certainly something that is on the mind of investors. And it's not necessarily pejorative. It's just a simple reality of the ambitions, both in a societal point of view and from an economic point of view from Democratic lawmakers. There will probably be further stimulus. You can make the argument that that has been inflationary. I would push back against that to a great degree when you consider the fact that we've had expansionary fiscal policies since the financial crisis, and we've only had inflation that has troubled lawmakers since the pandemic. So it certainly seems to me that the pandemic is a much larger proportion of the acceleration that we've seen in CPI vis-a-vis anything that we've seen in terms of increased spending. But that's a conversation for another day. It's ultimately what sort of policies will be put in place by lawmakers, or at the end of the day, what cannot be put in place if there is gridlock in Congress and, of course, an executive of a different party. But that risk is certainly something I think that investors have on their minds today. We're seeing solid but relatively muted gains, and really until all of this unravels over the next few days, and potentially, JD, even until December, if, as expected, we get a runoff in the Georgia Senate races, we may not know ultimately how this plays out until well past the Fed's next policy meeting in early December.
Yes, I'm sure if there's one thing that all Americans want, it's more campaigning specifically out of the Raphael Warnock, Herschel Walker race. If there's any race that has just worn down on Americans in commercials to say, please get this, or please get these commercials off my television, or get it out of the headlines. That is probably the race. And no, exactly. And that you're right. That is the race that we are going to continue to talk about for quite some time. In football, we say any given Sunday. In politics, I suppose we could say any given Tuesday. We don't know how things are going to shape up today. However, historically speaking, Martin, the S&P 500 has consistently moved higher in the one-year period following every midterm election since the 1940s. Any expectation to think that trend will not keep going? Of course, we're not dealing with a normal economy, and we've had a very difficult 2022, but it gives us some sense of maybe what we can expect for the next year, right?
No, I think you've hit the nail on the head, JD, in the sense that, yes, history has been on the market side with respect to post-election gains, and largely because it's been not terribly often that Americans have delivered consensus governments with all three parties controlling with the two parties controlling the two branches of government. So it will be interesting, I think, to see whether that is replayed going forward, because in my view, the headwinds that stocks face are far more significant than the boost that can be given by, shall we say, a sedentary Congress. Of course, we have a hawkish Federal Reserve. We have declining corporate earnings. We have the potential for a global recession. There are military tensions in Asia and Europe that continue to blunt growth prospects. There are aggressive central bank tightening all over the world. And China, of course, is doubling down on its zero COVID policy. None of those dynamics, and all of them are real, suggest to me that stocks have the potential to leg up in the next 12 months simply because there's a Republican Congress. So I think this might be the year, JD, that we don't get that kind of historical lift from the results of these midterm elections.
Do you remember the old Johnny Carson bit, Karnak the Magnificent? He used to do on his late night show. He was like the soothsayer. He'd hold up the envelope because he knows the future, right? Funk and Waggle's front porch. You exactly predicted where we were going. So I'm going to call you Karnak the Magnificent for this segment, because my very next question was regarding COVID-related developments in China overnight. Yeah. There's a little bit of a new reality that investors here stateside are now waking up to regarding an increase in infections there. Martin, what did we learn overnight?
Yeah, this is significant, I think, JD. We've had a 36% increase in infections in China. The number now of sort of organic infections, if you will, inside the country is really small. It's only about 7,500, but it's markedly higher than it was just yesterday, and certainly significantly higher than it was a couple of weeks ago. More troubling, JD, is the fact that it's spreading across various cities around the country, and it's not simply located around the central industrial area as it has in the past. This is probably not going to convince policymakers in Beijing to ease those COVID restrictions or indeed that zero COVID strategy anytime soon. And that, of course, raises the risk for industrial shutdowns, supply chain disruptions, and all sorts of other things coming out of the Chinese economy. And as you'll remember, over the weekend, we had the first series of data that showed a simultaneous decline in exports and imports since the pandemic of 2020. So this is really worrying, particularly when Beijing is pursuing policies that have clearly not performed as advertised. They are trying to get to zero COVID, and they simply haven't been able to, largely because, as most epidemiologists will tell you, it's simply not possible. So I think that will end up being a significant risk. We saw it played out in Apple stock earlier this week, and I would imagine we'll see that in other tech stocks with China exposure going forward.
Yesterday, we discussed at length the China COVID impact on Apple, specifically at the Foxconn plant in the Zhengzhou region. And remind us again, now that we had the conversation yesterday, we've got news overnight, so I want to ask you again, for people who may have missed yesterday's show, what other big names outside of Apple most come to mind for you, Martin, who might now also face significant headwinds because of China's ongoing approach to COVID?
Well, certainly, I think you've isolated the most significant one, and that is, of course, Foxconn, because it's the biggest assembler of handsets in the world. So Samsung is going to be a company that will have some implications because, of course, it has manufacturing bases in China as well. Clothiers or any company that is taking in Clothing at the wholesale level for retail sale in the United States are also likely to be implicated by that because of the potential for industrial shutdowns. But I think the other name that is absent in these discussions, JD, is Tesla, which of course has its most important gigafactory in Shanghai. That was shut down over the summertime, actually shut down in the spring as a result of COVID restrictions, shut down in the summertime for scheduled maintenance. And indeed, it could be vulnerable to a similar closed loop situation or a shutdown between now and the end of the year if these infections were to continue to spread. And that might be why the stock has felt pressure in the past few weeks and indeed the past few months. But it's certainly a risk, if not identified at the moment, that may come to the fore reasonably soon.
I do want to turn our attention here to earnings if we can. Let's talk Activision Blizzard. That company reported after the bell yesterday. Martin, did we learn more about the expected $69 billion takeover by Microsoft?
The company was reasonably confident, JD, that the deal was going to be concluded between now and the middle of next year. We still obviously don't know what European authorities have to say about that. We are likely to hear a little bit more about their probe into the deal in the coming days. We know that authorities in the United Kingdom have also been concerned about the takeover because they are worried that Microsoft will begin to restrict some of the games, most particularly Call of Duty, for sale on other rival consoles. Microsoft, of course, makes the Xbox. Sony makes the PlayStation. The last thing that competition authorities want is a restriction in consumer choice, because that tends to lead in an increase in consumer price, the last thing anybody needs right now in an inflationary environment. We didn't get a conference call from Activision because of the pending deal, and that's typical and certainly not something that we should hold against the company. So we won't absolutely understand their forward look in terms of the video game industry, although it was reasonably optimistic in terms of what they saw in third quarter sales for Call of Duty and the expectation for releases in the coming year.
After the close today, we're also going to get numbers out of Walt Disney. Talk about highly expected. We expect to hear more about the strength and growth of Disney Plus, of course, as a major player at the streaming table. This in addition to signs that theme park attendance is trending up. What will you be following?
I think the theme park numbers are really interesting, JD. That was the mega growth driver in terms of revenues last quarter. As a result, of course, of theme parks around the world that are reopening in the wake of COVID restrictions. The caveat there, of course, is China, where Disney Shanghai was actually locked down last week. And if you can imagine, visitors were actually kept inside until they could prove a negative COVID test. That's just an extraordinary event that really doesn't do much for the brand in that country. But you're right. It's ultimately going to be a streaming services story. I think the expectation is for subscription increases of around 8.9 million. That will mean that Disney will overtake Netflix again as the world's biggest platform. But I'm also interested, JD, in whether or not Disney will talk about reports that suggest it's going to offer kind of an Amazon Prime sort of service, or one that's similar, that will allow customers to buy different products and spend more time within the ecosystem as a way to boost revenue. Because one of the big drivers of Netflix stock gains over the past few months has been that ad-supported service that they launched in the beginning of November. That, of course, has sort of eroded some of the subscriber losses and put the stock on a bit firmer footing. If Disney can mimic that, they can probably offset the fact that they're seeing slower subscriber gains as we all head outside and do more things compared to our activities in the early post-pandemic world.
And of course, since it launched a few years ago, Disney Plus has not been profitable. However, the company has said earlier this year that it sees a pathway to profitability specifically for the streaming end by September 2024. Can the company turn around given the competition in the space? A, B, do you have a favorite Disney Plus show?
Oh boy, favorite Disney Plus show. That is a great
you weren't
question.
expecting that one.
No, I was not respecting that one. I mean, do the Pixar programs count? I mean, am I allowed to choose one of the sort of legacy movies? I would probably say that. There's a recent Pixar release called Soul. I don't know if you've seen it, but it's absolutely brilliant. It's really thoughtful and fascinating, and just an excellent way to describe some really profound topics, not only to younger viewers, but to older ones like myself. So I truly enjoyed it. That Pixar studio is just... they're batting 1,000, really. I can't think of a movie that they've released that I haven't enjoyed. I think it's terrific. But to your second question about subscriber profitability, that's going to be more of a challenge because ultimately the content that you need to keep subscribers in and to entice new ones to join is, of course, increasingly expensive. Now, what Disney Plus has over Netflix is the fact that they have live sporting rights, which drive people into the ESPN universe as opposed to just the Disney Plus area writ large. And I think that's proven to be reasonably successful. But of course, sports rights, as we know, are becoming increasingly more expensive to acquire because tech companies such as Amazon and others also see the profitability there. So I'm not sure that that turnaround is coming anytime soon. And therefore, I think Disney is going to have to articulate that strategy very specifically to investors because it may take a couple of years before they have that kind of ecosystem that exists, the big tent for all kinds of subscribers, from which they can then generate profitability going forward.
Since you mentioned ESPN, before we move on, Martin, can you remind our viewers, because I'm sure we've had a lot of people who have seen all these headlines the last couple of years about potentially trying to offload ESPN, then you had that activist investor said, oh, they should, then he kind of backtracked. What is the latest sort of calculus with regards to Disney and ESPN?
Yeah, ESPN is staying within the Disney umbrella. There's no question about that. Dan Loeb, who runs a hedge fund called Third Point, has a 2% stake in Disney, I think, the last time I checked. And he was pushing for all sorts of changes within the company. One of them was to sell ESPN to raise cash and then to pay down debt and to make it more of a driver of growth as a standalone as opposed to one that's inside the company. Now, he backed away from that reasonably quickly. He did win a seat on the board for one of his allies, but ultimately he sort of agreed with Bob Chapek that ESPN and its position in live sporting rights, and particularly its ability to potentially lever revenue and profit from the growth in sports betting, makes it a more valuable asset within Disney than as a standalone entity.
AMC, I thank you for that, by the way, because I sat there with a lot of other people. Like, God, I've seen so many ESPN-related headlines. What is the latest? So thank you for the context. AMC also on the docket to report earnings after the bell today. I admit, Martin, for myself, it's been some time since I stepped into a movie theater. However, I do have tickets for Wakanda Forever, the sequel to Black Panther, on Thursday night. Speaking of Disney, what are some of the biggest points to watch here as AMC reports after the bell?
This is a really difficult one, JD. I think ultimately because we're just not seeing the return to cinemas in the way that a lot of investors would have envisaged in the post-pandemic world. And AMC, of course, is struggling under a significant amount of debt. It's trying to grow through a series of different businesses apart from its legacy theater operations. And it has a complicated equity structure as well that's enticed a lot of retail investors inside, but hasn't really created the kind of clarity and single narrative that maybe a lot of people would like. And I think that's a fair criticism. So I'll be interested to see what they have to say with respect to revenue generation and their anticipation for attracting people into the final months of the year. When you look at the lack of blockbusters that are out there, that's going to be a difficult task. And as well, what they're saying about some of these sort of secondary operations, the NFT marketplace, for example, is something that they have tried to establish and sort of cultivate, but it's been a slow process thus far. And of course, the broader NFT marketplace just hasn't materialized in terms of growth prospects as many people thought it would even just a few months ago. So I think there's complexity in the equity structure, there's concern about demand into the end of the year, and there's maybe a retail investor base that is growing, if not impatient, perhaps less liquid than they were as a result of pandemic stimulus. And I think all of this is working against the stock as we go into the earnings later today.
Are you a frequent moviegoer?
I am not, and I very much miss it because I enjoy being at the cinema. The experience is it's unique. It's something that speaks and reflects to our childhood and the way that we sort of enjoyed the first movies that defined the kind of art that we like to consume. So I do miss it. I think the last movie I saw in the cinema, if I'm not mistaken, JD, was the Ben Affleck, I think it's called No Way Back. Is that right? He plays a basketball coach. It was quite good, but that was just prior to the pandemic, maybe in February 2020. Yeah.
Oh, it's been a minute for you then. I'm saying, I was like, wait, that basketball movie was like, that was a while ago. Okay, Martin. Well, if and when you get the opportunity to go back, I hope you'll come back for a live report on the show and let us know about not just how the film was that you choose to see, but the overall movie-going experience, because it is important, right? It's part of the recovery.
I missed that popcorn smell.
Yeah. Yeah, you want that butter all over the popcorn just seeping through. And, it's a wonderful experience. I'm very excited to go back to the theater. Okay, let's move on here. Just breaking this morning as well, an important story that people woke up to. I do want to ask you about Michelle Gass, the CEO of Kohl's, announced that she's stepping down. Shares jumped on the news for the company. What else do we know so far? And I know there's a Levi Strauss connection there as well.
Yeah, that was really interesting, JD. About 2 or 3 minutes after we heard that Michelle Gass was going to step down, she's been CEO since 2017 at Kohl's and has been trying to drive a turnaround and attract potentially some private equity buyers. We found out that Levi Strauss is bringing her on as president. She'll leave Kohl's on December 2nd, start at Levi Strauss on January 2nd, and then from there, there's going to be an 18-month transition from which she will take over the CEO position there from Chip Bergh. So it's a really interesting move, but she's heading into a difficult situation in apparel because of the things that we talked about with respect to supply chains, input costs, and of course, consumer price inflation. That's a tricky business for sure. I think she's done well at Kohl's, although the last 2 years wouldn't necessarily define the success that she's had in the company. It's faced some pretty significant challenges. And of course, we all know how difficult it is to operate in that sort of legacy mall environment. But I think the fact that they weren't able to execute that private equity or indeed whole of company takeover for the summer was probably ultimately why she was able to look elsewhere. The company's bringing on a former CEO of Burlington Stores to run the group on an interim basis. They have given us some indication of what third quarter sales are going to be. They'll report fully on the 17th of November. But I think, again, this is a turnaround story that still has a long way to go. It's just going to be marshaled now by somebody else.
I do want to move on to our rapid fire section here for the show with whatever remaining minutes we have left of the broadcast. First up, Lyft also reported, Martin, after the bell on Monday. We broke down some of the differences with Uber on yesterday's show. It was apparent in the earnings. The company posts surprise Q3 loss. What is causing this bumpy ride? Oh, shout out to our producers there for the pun. What's up with the bumpy ride?
Ticket to Ride, yes, exactly. Listen, I'm a sucker for bad puns. Round numbers and anniversaries, like pretty much every other journalist in the world. Basically, they had weak-ish rider growth. I mean, it was up 7.2% from last year, but it did miss street forecasts. And I think ultimately, even though they had better than expected gains in the average revenue per rider, those rider gains were just not strong enough to support not only the stock's performance, but what they had to say about the final 3 months of the year. They're going to see relatively flattish revenue for the December quarter when compared to the September quarter, and that's absolutely not what investors were looking for following that upbeat forecast from Uber. Now, of course, the two differences between the company are scale and breadth. Uber, of course, has food and drinks delivery alongside the ridership and international operations and a much larger U.S. operation, for that matter. That's very different to Lyft, which has much smaller operations that are targeted to specific urban areas around the United States. So that makes an apples-to-apples comparison reasonably difficult. But nonetheless, the fact that we're not seeing that optimistic final month's view that was iterated by not only travel companies, but lodging companies such as Airbnb and indeed Uber itself. The stock is really getting punished this morning. When I checked it last, it was down about 18%.
Moving on to number two, how is Nvidia circumventing U.S. export restrictions? Very important in the semiconductor space.
Yes, a huge story, actually. Reuters broke it, and it was ultimately confirmed by Nvidia that they have developed basically a high-tech data center chip that is dumbed down just enough to meet the export restrictions that were put in place by the U.S. government last month. The government, of course, is concerned about sending that AI and high-tech technology to China for fear that it will be used for military purposes or even potentially to surveil citizens here in the United States. So those restrictions were put in place. Nvidia warned that they had about $400 million worth of sales that might have to be scrapped if they couldn't come up with an alternative. And it seems that they have. The company said that the U.S. is happy with it from an export perspective, and therefore they'll be able to sell it to China customers. So that's not only going to rescue that $400 million in sales that have already been booked, but hopefully grow revenues in that country without compromising security concerns in the months ahead. So very much an important story for Nvidia, and the stock is reacting in kind.
Let's move on to number 3. Does Take-Two Interactive need to hit the reset button, Martin?
Yeah, this one is not looking good. The NBA 2K franchise is doing very well. They've only released a new version, and it's already had about 5 million in sell-ins. So that's been better than anticipated. But they haven't been able to generate the kind of revenue growth and profitability that people would like to see. They're seeing weakness in-game spending, and I don't think that's a surprise, given that a lot of it, you could argue, was the result of pandemic-era stimulus. So people are spending less time in some of the mobile games, and certainly less time in the console games than they were before, and they're spending less whilst they're inside those games as well. For those of you not familiar, in-game spending is a significant portion of revenue growth for video game companies all around the world. So that change is certainly important. They had a relatively muted outlook for the December quarter, even though they say some of the releases that are coming up are going to blunt some of their concerns. With the macro headwinds, the foreign exchange headwinds as a result of the strength of the US dollar, and that pullback in consumer spending from the video gamers themselves, all combined for that outlook and a big decline in the share price today.
And finally, number 4, while we still have you, Tesla is flirting with a 17-month low. I noted it opened the day at 197. Real quick for the latest number for this, down to 188 right now. How does it get back on track?
Oh, my word. That's a difficult one, JD. That, if my arithmetic is correct, is about $680 to $700 billion worth of value since its peak in early January of this year. That's an incredible slide. And the stock has lost about 50% of its value since Elon Musk made his intentions to purchase Twitter public in the early part of April. Now, of course, we know that Musk has had to sell several $1 billion worth of shares to satisfy some tax liability. He's also had to sell shares to pay for the Twitter acquisition. And from all accounts, we seem to see that he is distracted and focused on establishing Twitter and its place in the social media landscape vis-a-vis the typical time that he would spend at Tesla and some of his other companies in which he is the CEO. That's just simply not a combination that's going to inspire confidence, particularly when you have input costs rising. Of course, for Tesla, there's concern about end demand, and ultimately there's concern about supply, given the fact that China is still susceptible to COVID restrictions. So you put those all together and you have tremendous downward pressure on a share that was once the darling of the tech space and is now, as you say, not only trading at the lowest level since 17 months, but shedding about $700 billion worth of value in less than a year.
I mean, it's incredible. The post-Twitter sell-off has the stock setting in a new 52-week low, like you just said there. Investors are bracing for a recall of tens of thousands of Model 3 X and Model X EVs as well, plus headwinds in the form of China. My goodness, all those things working against us. It's incredible. Look at the 5-year stock chart of Tesla, which I have up here on my screen. It's like really incredible. Right now, the stock is trading down 4.3% today. And we're only 33 minutes or so into the start of the session. Martin Baccardax, thank you so much. Happy election day to you here, my friend. Stay safe. And the best news is we get to do it again tomorrow. Thank you, Martin.
Thanks, JD.
All right, folks, that's going to do it for the Market Open here from the floor of the New York Stock Exchange. By the way, it's not just a sticker that you get here in New York City. If you're lucky, you'll also get a pen. I used this pen to fill out my ballot in Queens, New York today. So listen, New York City, spending where it matters most, folks, stickers and pens. But you want to go do it. Go be a part of the process. It's a great day. That's going to do it for the Market Open here from the floor of the NYSE. Stick with TheStreet.com for more on these and all of the major market stories that matter to you. Go vote. We'll see you tomorrow.